All right, so here's a 1 minute chart. You can see that sell side liquidity pool here, I'm highlighting at 19,901.25. That is London's low overnight around 3 o'clock in the morning. And there's that buy side again at 19,996.25. And here's the first presented fair value gap. And I already highlighted it in orange, as I usually do, denoting that that is going to be treated as not a sell side imbalance, buy side inefficiency to go short end. Remember, last night's bias, bullish. And at 9:47, I think right about in here, I tweeted and said that we would see this very gap right there at 9:38, 1 minute candle. And I probably should have added that, anchoring it into this, but you can find it on X. It is what it is. But the draw on liquidity would be here, but not before treating that gap as an inversion fair value gap. But we had 10 o'clock news. So at 10 a.m., we had ISM manufacturing PMI number. You can find that on Forex Factory's calendar. You can find it on the Conoday's calendar. Any reputable economic calendar will tell you what medium impact or high impact. And it was a high impact news driver at 10 o'clock. So you have to wait for that news to deliver. So it went up there, stopped short of running that high, came down, took out the sell side here, and one more time sweeping below that 3 a.m. London session sell side liquidity pool. Why would they want to go down there? Because they're going to pick up all these orders down here that are resting to go short on a breakout or to protect a long position. So either way, sell side or sell stops, sell orders, pending orders to be a short seller, are resting below that level. So the algorithm drops down there to accumulate here, all through here, and then after 10 o'clock, it rallies higher and then goes above that 938 first presented fair value gap here. It trades above it, then comes back down in. It does not, notice this here, it does not break that low. It comes right in here. Look at the body. So what is it doing? It's validating this as an inversion fair value gap after that news driver. So because that news driver was a volatility injection, we have to be careful because it's a Thursday before non-farm payroll. It could do all kinds of things and mess up, your analysis, your trade. It could hurt you. So that's why I tell you, if you're not a seasoned veteran in terms of what I teach and been around for a while or know how to trade and been trading for a long time, you probably shouldn't be trading on Thursday and Friday of non-farm payroll at all. But it comes down and validates it by not going into the lower half, or even in this case, consequent encroachment, and then rallies. That was to me confirmation that, okay, it validated it. So now I got to find an entry. Because if I think that it's going to trade up into that volume imbalance, then best case scenario, what would the best case scenario be as an exit? If you're trying to get long using this inversion fair value gap down here, and you're aiming for the volume imbalance on the daily chart, which is shaded in that red area here. As you can see, March 27, 2025, daily volume imbalance. Okay, so just remember, look at the first portion of the video where I was showing you the daily chart with the lipstick on it. The best case scenario exit would be at the high of that volume imbalance, right? Wouldn't you agree? So aiming for an entry at the first presented fair value gap, which is going to become a inversion fair value gap, and then rally up to first pool of liquidity is this 19,996.25. So that's a low hanging fruit objective. Very, very easy. And 20, 30 handles obviously would be warranted as a first potential profit scaling out. And also in keeping with what did I give you this week as a challenge, mission possible. 30 handles in the morning, 20 handles in the afternoon. So because I got things to do, places to be, and people to see, and I'm going to have a 3-day weekend, I'm just going to just crush it today and just do what I'm showing you here. You will be able to see on X me closing the trade when it hits the limit order with what I'm about to show you. But my entry strategy, let me show you what that is, okay? Because you don't have to always get into the trade at the PD array that you're looking for. You're going to miss entry sometimes, folks. That's the reality of all this. You're not going to get your best entry every single time. You could be watching the chart, you could be dialed in, zero distractions, and you simply do not get in. What do you do in that case? Well, in my case, because I have 81 ways, and you can times that by 2, to get into something or out of something as a trade, I have a plethora of dandy little tools and techniques and concepts that I've authored that no one else can do as well in their hands as I'm doing with my hands, because it's my stuff. So I'm teaching it to you so that way you can grow, hopefully, an affinity for one or two of them at most in the beginning, and just try to grow from that. But let's take a look at what it is that I use to get into the trade. This candlestick right here, and I have an arrow below and above the candlestick I'm denoting. That candlestick's open down to its low. That is its discount wick. In other words, it's the wick below the candlestick. We call them shadows or tails, and anything above as a wick would be obviously the wick. Okay, so I'm denoting that midpoint or consequent encroachment of that lower portion of the candlestick that makes that wick or discount portion of the candlestick. That's this line right here, and I'm projecting it in the future. The next candle after that, you can see here, I'm denoting it with that arrow here and that arrow here. I'm doing the same thing here. That wick, I'm highlighting the midpoint. This is my gray pool, okay? You're not going to know what that stuff is or even what this is unless you learned it from me, okay? There is absolutely no way you've heard it anywhere else, but it's my concept. It's codified, coded, and signed by good old ICT. Algorithmic gray pool, you extend that in the future, okay? And that is your portion of where you can get in. Now, I already know what you're thinking. Wow, that's really not anywhere close to the inversion fair value gap or first presented fair value gap. Isn't that chasing price? I'll get to that in a moment because I already know what you're thinking. But right now, I want you to take a look at the entry. Okay, here's the entry, and look real close right there. You'll see that that is me getting in at the low of the gray pool. Okay, and now I'm going to show you up here me getting out of the trade right there. There's a little caret symbol saying I'm getting out at the high of the volume bounce in the daily chart. Folks, that is as perfect as you can get without getting in at the inversion fair value gap here. You're not going to see anybody else do it like that. And you're never going to see anybody else do it like that, because I have things that are going to help me be light years beyond everybody else out there, but I could still be your good old friendly neighborhood mentor and teach you lots of things that will help you get into trades like this. But your experience level may not give it to you right away, and it'll frustrate you trying to trade with this measure of precision. You don't need to be this perfect. You don't need to be this precise to make money or consistently find trading setups or make money drawing out a monthly income. You're going to take losing trades. You're going to do it wrong. And when you see things like this is me just basically putting a cherry on top this week because, well, let's just put it this way. I really enjoy doing this, okay? And unfortunately, this is the part that makes it sound like I'm narcissistic, arrogant, whatever. And that's not what I'm trying to do here. I'm trying to be somewhat entertaining with folks that have a sense of humor. Also, to kind of like rib those individuals that don't think I know how to trade or don't think I know what I'm doing, and because I'm calling it in advance the day before. And at 9:20, I'm sorry, what is it, 9:47 today in here, I told you that this is going to be used as an inversion fair value gap to go up to here. And last night's analysis said it's going to go up to here and here. Okay? But take it one step further, ICT, the consequent encroachment of March 27th daily candlesticks wick, the premium wick. That's what this level is here. So while I was watching it today, this could have delivered or fell short of it. And if I was looking for that to exit, I would have been probably disappointed. But in this case, you can't get better than that in the high of volume imbalance and be content with that and just watch it go to another level that I expected. Anyway, whether I mentioned it last night or not, it doesn't make a difference. You did know about this portion here. But now, once it trades at that level, I'm done for the week. I'm not interested in doing anything else. So in keeping with what I taught in the last Saturday's X space, when we move away from the first presented fair value gap, because it's doing two things here, acting as a inversion fair value gap, which I told you it was going to act as way back here. Okay, so before it delivered it, and you can see on X, ask your friends and neighbors if I ever delete or edit anything on X, because I don't. It goes down through it for the purposes of upsetting the liquidity that's resting below London's low and this low that formed. And then they rally it back up into the inversion fair value gap candidate, but does it offer that validation? Nope, it goes in there, goes right back out. You have to wait. You got to wait. And the market goes below that once more and then rallies above it trades back down into it, and then runs away. That's validating it. That is verifying that that is absolutely what I said is going to be at 9:47 a.m. Eastern Standard Time. It was going to deliver this way. Now I have to find another way of getting in. Now, let's say you didn't want to use the gray pool. Maybe you don't understand it. Maybe you don't want to touch it. It's complicated. It's complex. You're making it difficult, ICT. Okay. Well, I'm teaching technical science. If you want to do simple stuff, you can do my immediate rebalance, which is this candlestick's high. It rallies through it here, and then the next candle opens, trades right back down. That candle's high. That's an immediate rebalance. And the next candle or the next candle after that, price will start running. That's the rules. If you're in my mentorship, if you watch my mentorship content, that you can see right on YouTube for free. Okay, I uploaded everything. It's all in different playlists. Just go through the playlist, all the videos that's on there. It's absolutely my gift to you as a community in trading. That rule of immediate rebalance, it sees price rip higher and it goes right to that pool of liquidity as a very low-hanging fruit objective. In and of itself, that right there is enough to be content. If you're a brand new student, new trader, looking for a way to find setups, I'm literally laying it out there on a silver platter. But you have to determine what you're going to use as your model. You could have used these two consecutive down close candles here as my bullish order block, and right there and there, it gets you an entry. So it's not a matter of, oh, you know, this is too many things to worry about. It's not. It's just, what are you comfortable with trading with? And there may be a PDA that you like that didn't provide you an entry for this setup. It doesn't mean the concepts don't work. It doesn't mean you won't be consistently profitable in the future. It just means that your model, your PDA rate didn't give it to you on this run. And because it's not farm payroll Thursday, you shouldn't have any worry about that. It should be no sweat, no problem. Next week, not next tomorrow or Friday. That's a day that you shouldn't be trading if you're a brand new trader. It's a carnival ride at 8:30 tomorrow morning Eastern time. It's going to go crazy all over the place, and it's better if you're not there, if you're not skilled or, I guess, experienced. But now that first percent of fair value gap, because we completed the weekly objective, my weekly objective, price has already booked what it should have done, then it's reasonable for price to do what? Start seeking discount arrays. Well, that would be starting in here, midpoint consequent encroachment of the daily volume imbalance, then the low of the daily volume imbalance, and the high of that April 2nd daily premium wick high. And then if it goes below that, what could we trade for? Back down in the first percent of fair value gap. So I'm going to extend this here in time. And I'm also going to show you that for those that were wondering, is this chasing price? No, it's still in a discount. Because if I'm looking for, as I mentioned in 9:47, 1 minute Eastern time, or not 1 minute Eastern time, 9:47 Eastern time today on X, that I would be using or looking for this 9:38 candle to act as an inversion fair value gap. It's the first presented fair value gap of the 9:30 to 10 o'clock opening range, which is 30 minutes. If I'm aiming to look for the setup here, and I believe that the high of that volume imbalance on the daily chart is my draw and liquidity, the perfect terminus exit for me. So I'm going to frame the entry off of the inversion fair value gap here, draw the fib up to that high of the volume imbalance. The 50% level of that range is here. So everything above that line is a premium. Anything below that line is a discount. So when I'm entering here inside this gray pool, am I entering at a premium? No. So again, there's a lot of people out there that love the terminology and the outlines I've created for just describing and determining what a premium and discount market is, but they don't necessarily understand exactly what they're doing. Okay, and you got to keep watching my stuff and practicing and listening to the lectures, because just because you know the words and you can draw a fib with the 50% level on here, you may not be properly articulating what a discount and premium market is. But we're going to extend that first presented fair value gap in the future, and now it becomes a discount array. So it's going to draw price down into, as it does right there, and stops dead in its tracks, where some random level of a consequent encroachment of the first presented fair value gap. Rallies back up to our old buy side liquidity here. Remember, liquidity pools can act just like any other array. Just because it went up there and swept that liquidity doesn't mean that they won't use that area again. Remember, the algorithm doesn't know how many orders are at that level. It's just going to go to that level to offer fair value to the marketplace, not for your purpose of entering a trade, but for smart money. So the market trades up there once more, breaks lower, fair value gap hits it here, trades down to first principal fair value gap again, and into this small little gap here. We won't go into that. It's not even that important. Rallies one more time, trades back into the first principal fair value gap, and trades up into this run here, back into this little gap, and then sells off back into the first percent of fair value gap once more, and trades back up. Now, keep an eye on the levels you see here, okay? 19,901.25 is that sell side liquidity pool from the London's low. And then we have the old buy side liquidity. And then we have this line's going to disappear. It's not salient to what we're going to see in the afternoon. And then we're going to extend this daily volume imbalance over as well. And I'll leave this here for reference. Okay, so the chart looks slightly different, but there's your me exiting there in the daily volume imbalance, and it uses the first percent of fair value gap to rally up and works that level, that old initial buy side that I gave you at 947 on X today in a post. Trades back up to the wick high of April 2nd, daily premium wick high, hits it perfectly, stops, comes back down to the old buy side liquidity pool, back up to the wick high, and then we're going to start looking for the afternoon session run that goes into last hour trading. We can see it one more time, trade up into that daily volume imbalance here, consolidates around the old buy side liquidity pool, and then breaks aggressively lower back down in the first percent fair value gap, trades through it, trades below the London low again, fails to get back to first percent fair value gap, and just gives up the ghost, breaking lower. And this level here is the midpoint of April 2nd, 2025's daily premium wick. That's the wick high, and this is half of that wick on the daily chart. It draws down to that and below it, consolidates around that, and then we start the new day in here with a new day opening gap.